Hey y'all, today we're starting a 5-part series for Introduction to Futures, all the way from the beginning, the history of futures, to the contract rollovers, and everything in between. So if you're familiar with stocks, options, foreign exchange, we're going to compare those and show you why it's such an advantage to trade futures. So enjoy this series and let's dig in. A futures contract was originally designed in the late 1700s. This was an agreement between a farmer and a merchant for a product that the farmer was growing. It could have been something like corn, wheat, soy, anything of that nature. What the farmer wanted to do was ensure that he could sell his product at agreed upon price to the merchant. The merchant had the same feelings and wanted to go ahead and make sure he could lock in enough product for his shelves at agreed upon price to pass on to the consumer. Now, in the mid 1800s, the Chicago Board of Trade, which is the CBOT, got involved and saw that these contracts could be spread out across the country. So they designed an exchange to help the farmers and the merchants take the product sales or acquisition across the entire country. Now, commodity futures are still traded in the modern era. I'll use an example between an airline and an oil producer. Airlines know that they have a huge amount of travel that happens during the summertime or even during the holidays. And they want to make sure that they get a good fuel price for those peak seasons. So what they'll do is they'll purchase a futures contract at an agreed upon price, and the oil producer knows that he's going to get that price for that contract during that time. This helps hedge and save on both ends of that contract, making sure that they get a good price for the airline and the oil producer gets a fair price for his production. Now let's go ahead and discuss index futures. In the early 1980s, the Chicago Mercantile Exchange, which is a CME group, introduced futures as contracts. That is an example of the S&P 500, the NASDAQ 100, or the New York Stock Exchange. Now what you could do is purchase a contract, which is all 500 companies under the S&P 500 as one contract. All you have to do as a benefit for this is to decide if you're going to purchase the contract long or purchase the contract short, meaning that you're going to either buy it or you're going to sell it. So as you do your analysis, all you have to do is decide, I'm going to purchase a contract. I'm deciding that I'm going to go long, which is buy it. As you purchase that contract and it moves upward, you close out of that contract. Any points that it moved upward, you would make that financial gain from that contract. It works the same as a sell. You would sell that contract. You would go ahead and, as it moved lower, when you decided to close that out, any points that it moved down, you would close that out and realize those financial gains. That's the best part about futures contracts, is all you have to do is decide if you're going to buy or sell.